Welcome to the financial accounting section of the accounting boot camp. I'm briefly going to just talk about some of the key topics in this short book. Again, I told you it takes about an hour to read, maybe a little bit longer than that if you want to study it, but it really does a great job of explaining the mechanics, the technical side of accounting, which oftentimes really helps you in your mind understand what the accounting function does in any organization. I'll also look at the financial accounting part of this particular text as well, which is about half of the book. The other half of this book is, as it says here, finance. And as you get into looking at some of the topics here, that's what Dr. Tryon has in her finance boot camp. So going through this is like through the accounting first is a great feed into what you're going to see in the finance boot camp. But briefly just going through here, and I'll just spend just a few minutes talking about these individual topics, even though it is self-explanatory. I'm just going to touch on this. Again, much of what I'm going to say has already been said in the first video. That's about 15 minutes, the overview, where I talked about financial accounting, managerial accounting, obviously the case studies as well that you're going to encounter when you actually take accounting 5150, accounting information for decision making. So jumping in here, financial statements, the accounting equation. The accounting equation is assets equals liabilities plus equity. Now, some textbooks like to take the equity part of that, and they will say equity is plus revenue minus expenses, which is okay to look at it that way. But in essence, that's like pulling out of the accounting equation, assets equals liabilities plus owner's equity. If you pull out the plus revenue minus expenses, that's actually the income statement, the second statement, right? Because we're talking about the balance sheet, when we talk about the accounting equation. And when you think about that equity, why do you plus revenue? Well, again, equity has a normal credit balance, right? You'll see that when you get over here into chapter 47, or excuse me, page 47 of this text. It'll talk specifically there about debits and credits. The normal balance for equity is a credit. And those are things you just have to take for granted. It's like I said last time, it's like dropping a pencil and hitting the ground. That's gravity. Well, you assume gravity is the law that we live under, right? It's not a hypothesis, it's a fact. And so you have to do that with accounting as well, that revenue has a normal credit balance, equity has a normal credit balance. The only link between the balance sheet and the income statement is retained earnings, and retained earnings has a credit balance. So if you have more revenue, meaning I've got more credit than I have expenses, which are debits, then obviously my retained earnings is going up through a credit entry. So keep that in mind here when we talk about the accounting equation. It says it's always true, there's no exceptions. They also have here in the table of contents, owner's equity is just a plug. I use that term a lot when I teach accounting to accounting majors, plug numbers. That's sometimes people don't like to hear that, but that's a fact that oftentimes it is a plug. My asset is your liability. That's important as well to understand that if I'm in the business of selling in my company of some good, I worked in the battery industry for a number of years. So when we sold batteries to Walmart or Toyota, what would be sales revenue for us would be an expense for Toyota. And when we sell batteries, came off our books as inventory, went to cost of goods sold as expense from an asset to expense. Then we also would book the revenue as a credit, and the debit was to accounts receivable. So my accounts receivable for selling batteries to Toyota was accounts payable for Toyota. So you see how accounts payable and accounts receivable, two different companies, they mirror one another, just like we had revenue for batteries, they had expense for batteries. So that's important to remember. My asset is your liability. You make a deposit at a bank, right? You make a deposit, maybe you take out a $10,000 CD, you give the bank $10,000, and that's something that they owe you. That's a liability on their books as a deposit that they have to pay back to you along with the interest that they're going to pay you. But that's an asset on my books. An asset on my books is a liability on the bank's books. The second chapter here is on the balance sheet. And the balance sheet, again, it is a snapshot. Last time I talked about a balance sheet being a point in time. It is a point in time of what your balance is of assets, liabilities, and equity, ignoring revenues and expenses. Again, we're pulling that out. That's an income statement. So we've got assets, liabilities, and equity, a point in time. It's a snapshot is what this writer calls it. It's a snapshot. We do want to break that down to current assets and current liabilities. When you get into finance, you'll find out all those ratios that are used to compare current assets and current liabilities to see if you're solvent, if you can pay your bills. Oftentimes when you're putting financial statements together, especially a cash flow statement, you got to have two balance sheets. You got your beginning of the period balance sheet, which in essence is the ending period balance sheet from the prior period, and your current balance sheet. And so you're comparing, when you're doing a statement of cash flow, is why did my cash change from this balance at the beginning to this balance at the end? It's because they are a point in time. It's a snapshot. All right, chapter 3 is about the income statement. Again, the income statement is for a period of time. And that's what the author here says. It shows period of time rather than a point in time. So you got two balance sheets here, right? And between those two balance sheets, which are a snapshot of assets, liabilities, and equity, in between those two is your income statement, a period of time where you recognize your revenue and your expenses. Book your revenue, match expenses with that, and that tells you what your net income or loss is. And then that gets closed out to retained earnings on your balance sheet. That's the only link between the income statement and the balance sheet is retained earnings. All right, chapter 4 is about statement of retained earnings. That's just a way to show your beginning retained earnings. What was my net income that gets added to that? Because again, if your revenues exceed your expenses, you got more credit than you got debit going into your income, going into your equity through your retained earnings, then we want to show that here's our beginning balance. Add your income or subtract your loss. You're also going to subtract dividends that are paid. We'll get into that later because dividends are not an expense, as the book says. It actually comes out of retained earnings. When you pay dividends to shareholders, if you have stock, that is coming out of your retained earnings and out of cash. Number 5 is your cash flow statement. Again, you have to have two balance sheets, right? If you're trying to show what happened to cash from the beginning of the period to the end of the period, then you got to have two balance sheets and also an income statement. And through your statement of cash flows, you're going to show my operating, my financing, and my investing activities, all three of those. Actually, it's operating, investing, and financing in that order, OIF, of what happened to cash from one period to the next. In essence, a cash flow statement, which is the third most important statement, again, behind income statement, balance sheet, and then statement of cash flows. The statement of cash flows is in essence showing, taking your accrual basis of accounting net income back to cash basis. Now that may sound confusing, but just keep that in mind. That's what the cash flow statement does. You're explaining what happened to the cash balance from one period to the next. And then chapter 6 is financial ratios. The finance boot camp will go into more detail there prior to the actual course that you take. Then chapter 2 or part 2, general accepted accounting principles. What is GAAP? Generally accepted accounting principles. As I pointed out last time, that's what Financial Accounting Standards Board primarily drives, promulgates, and it's the SEC that enforces that if you are a publicly traded company, Securities Exchange Commission. Because the overriding consideration of companies is make sure they've got financial statements that are not materially misstated, because that's going to drive investor confidence to invest in those stocks that makes the stock market go up. And that's why GAAP is very important. A GAAP is for accrual basis of accounting. So as we get into chapter 8 of this short text, it talks about the double entry system, double entry accounting. Again, if you put debits must equal credits. If you make a debit entry, you must have a credit entry. You can't make a debit entry alone. You can make a credit entry alone. It's got to be in balance. You might have a multi-level journal entry that's got 6 different accounts, but all your debits and all your credits have to be equal. Doesn't mean it's correct. It just means it has to balance. And so the double entry system is what we operate on. The general ledger is the actual current balance of your assets, liabilities, equity, revenues, and expenses. All accounts on a company's ledger are one of those five. It's either an income statement account, which are temporary, they get closed out to retain earnings, or they're permanent accounts, assets, liabilities, and equity. T accounts is a way to show the activity that's going on within a particular general ledger account. You don't have to use those. It's a great teaching tool. I used it as a controller late in my career to, in my mind, understand what was going on with the balance there. So I strongly encourage accountants to use that. And of course, the trial balance is showing the balance of all of your 5 different types of accounts. You might have 10,000 of them, but the trial balance shows you your current balance of debits and credits. And at the bottom, that the debits do equal credits. Of course, any software worth its price is going to have balances at the bottom that it's imbalance. It's not going to allow you to make a journal entry that is unbalanced. But like in the old days, when you did everything on a ledger pad, you kept track of it manually. Then chapter 9 is about cash versus accrual. You know, the IRS, all they care about is the cash basis. A friend of mine I was talking the other day, he owns several rental properties, and he's talking about damage that someone had done to his property. And of course, usually when you lease, well, always when you lease something, they want a damage deposit. And say it's $600, I think is what his was. And if somebody moves out and it's been damaged, then he keeps that $600, right? And he uses that to take care of repairing that. But with the IRS, that $600 he received when the lease began, he has to report that as income, because the IRS, even though that's a deposit, and from a financial reporting standpoint, that would be on your books under the accrual basis as a deposit. It's not income, it's not revenue. But under the cash basis, if you've got cash coming in for $600, even though it's there as a deposit, the IRS says you have to pay tax on it. Now, obviously later on, if he has to spend that $600 to repair that, then he claims that $600 as expense at that point. That's a great example of showing cash basis accounting versus accrual basis. Again, accrual basis, financial reporting through GAAP, which is required by the SEC, which obviously is required for any company who is publicly traded. All these companies like Google and Netflix and Eastman and so forth, they have to use accrual basis. But that $600 that would be received for potential future damage would be on the books as a debit to cash and a credit to a liability, meaning they might have to pay that $600 back, right? So that's accrual basis versus cash basis that the IRS uses is cash in and cash out. It's all about when you recognize the revenue and the expense. The accounting close process, you can read about that in chapter 10. Chapter 11, GAAP concepts and assumptions. You know, I talked about this in the last video of the boot camp. There are 7 case studies in the actual ACCT 5150 MBA accounting class. 7 case studies. There's no exams. Those 7 case studies are, you have to do research and you are going to write about various accounting principles. And in some cases, in several of the cases, that there was fraud involved with the violation of these principles. And when you look at those key principles, they've just got 5 of them listed here. The ones we're going to look at primarily are revenue recognition, expense or matching or the cost principle, materiality. Of course, disclosure is a part of all of those, but those are the ones we're going to focus on. I always say revenue recognition and the matching principle is what accountants spend 95% of their time on. So that's why we really hammer away at that on the first 2 cases. But here in this text here, as you read through this, because this is going to give you a great foundation to understand accounting in a very simple way. So when you start looking at these cases, it's going to make more sense. So they've got here historical costs. That's how items are recorded on your book. Historical costs. What did you write a check for? Or in order to purchase something. Historical costs. Materiality. What is materiality? Not about material, it's about significance. Now, when I was at Nuclear Fuel and Exide and Lear and really any company I did work for, materiality when it came to capital assets is if you spend $2,000 or less than $2,000, you could expense it. Didn't matter if it was going to last 5 or 10 years, you would expense it. If it was $2,000 expenditure or more and had a useful life of more than a year, which is the definition of an asset that has to be depreciated, then it would be capitalized. And by capitalized, meaning you would debit asset and credit cash when you bought the asset. If it's something immaterial, then it was okay, less than $2,000. It didn't matter if it lasted 10 years. It was okay to expense that when you purchased it. Like calculators. I mean, these calculators are cheap. They last 10, 20 years, but they're not worth putting on your books and depreciating. Materiality says you can expense that. All right, they also talk about monetary unit assumption, dollars, entity assumption, the matching principle, very important. I'm not sure why they don't put revenue on here, but they don't. Chapter 12 is about depreciation of fixed assets. Why do you invest in fixed assets? Property, plant, and equipment. Whether it's machinery or equipment, whatever it might be, property, plant, and equipment. You do that to drive revenue. That's why you invest in assets. Salvage values, most companies never use salvage value. The various depreciation methods, I can tell you about every company I know of uses straight line for financial reporting, but in their separate set of books for tax, they use accelerated depreciation. So again, that's a good example where you have actually two sets of books in reality of depreciating straight line for financial reporting. So you have smooth earnings versus accelerated depreciation. So you pay less tax now, more tax later. Over time, it doesn't matter. And then intangible assets, chapter 13, things like patents, copyrights. Chapter 14 is about inventory and cost of goods sold. Now you're getting to managerial accounting. This is really more about financial accounting, although it's about the accounting cycle in general. But here, inventory and cost of goods sold. Inventory is an asset, right? You remember that from last time? It's on your books as an asset, normal debit balance, right? And it sits on your racks as inventory until you sell it. Like when we would sell batteries to Toyota, it's out there on our racks as inventory. And then when we would sell it, it would come off our racks and go onto their truck as a credit to inventory and a debit to cost of goods sold. Very simple transaction. And the other side of that transaction is a credit for revenue. And the debit was to what? Accounts receivable. So 4 journal entries or 4 lines, 2 debits, 2 credits, right? Very simple. All right, so that is pretty much what I wanted to cover in that book. Now, if we look at this book here for financial reporting, and this goes into more detail, which I like, which is important. This is just like a whet your appetite. And if you thought you hated accounting when you were an undergrad, or maybe you didn't have undergrad business degree, maybe engineering or something, this is a great book to read about accounting and how the technical side of that operates, because it's really not complicated. You don't have to be good. You really don't have to be good in math to excel in understanding the numbers that run business. And you've got to understand the numbers to be successful in business. This goes into a little more detail. Neither one of these are textbooks. That's what I like about it. They're not textbooks. This is more like a desk manual of how to handle certain things that come up in accounting and finance. So very simply here, the first 8 chapters of this is about financial accounting. And then chapters 9 and 10 are managerial accounting. Again, financial accounting is about external reporting, right? To stockholders, to creditors, following GAAP, accrual basis of accounting, SEC, FASB, all those terms relevant to financial accounting. That's what we're going to look at here in these first 8 chapters. But then chapters 9 and 10 is what you do internally. How do you use accounting information to make decisions? How do you know how to price your product that you're selling? How do we know how to price batteries to Toyota or Walmart or whoever it was you were selling to? That was internal. Has nothing to do with GAAP. Has nothing to do with FASB or stockholders. It's how do you use the accounting information that you've got? How do you use your accounting information system, right? Because this class is called what? Accounting information for decision making, right? Which really focuses on really focusing on managerial, but you really need to understand the financial side of it as well. So what we see here in these 8 chapters, it starts out talking about financial accounting basics, not unlike what you saw here. Is it's going to drill down a little more detail of what's here into this book. Very important. The accounting process and cycle, the balance sheet, right? So this is a great, a little bit more detailed level of those. Really, it's meant for MBA students, right? What's the title of the book? MBA Fundamentals. Fundamentals. The balance sheet, the income statement, retained earnings, the statement of cash flows. Those are the 3 primary statements: balance sheet, income statement, statement of cash flows. And again, all accounts are either income statement, revenue, expenses, or balance sheet, assets, liabilities, and equity. There's 5 types of accounts. Statement of cash flow doesn't have any accounts. It's all reconciling your balance sheet accounts from one period to the next. What's working capital? Very important topic, especially when we start talking about in business. Property, plant, equipment, intangible assets, liabilities. They don't group equity here. I'm not sure why they put equity down here under finance. So I'm going to leave that out, and that can be handled in the boot camp in finance. And I know that's in there because I've already checked their curriculum content. But that's what these 8 chapters are about. And in the next video that we'll look at, the 3rd of 4, we'll talk about chapters 9 and 10. And I've also got another very similar to this called cost accounting, made simple. Cost accounting is what it used to be called. Now it's called managerial, but managerial and cost are synonymous. Cost accounting, managerial, it's about using cost behavior. What part of your costs are fixed? What part are variable? Things like contribution margin. Very important to understand as an entrepreneur, as somebody working in corporate America, in manufacturing, wherever it might be. You as MBA professionals and future executives really need to understand the managerial side along with the financial side. So look forward to talking with you again soon.